Hi, the interest rate is in a record low since I ever known the interest rate in New Zealand. So as a result, the house market is so hot and lots of people looking for buying investment property, which is fine if they can find a good property at a good price, because the prices are a bit crazy. But there are certain things that you need to consider when you're buying a rental property, as far as tax and protection and the things that you need to know in general to make sure that you're making the right decision. So what I suggest is have a chat with us or with another accountant to make sure that you've got everything sorted. But the things that you need to look for is, first of all, do a simple calculation to see whether your property is a cash flow positive or cash flow negative. So whether you're going to make money after you pay the interest on the mortgage and all the other expenses like rates and insurance and property managers and everything else to do with that property. So there are lots of hidden costs on the ownership of the house that you all know if you already own your own house, that you have to consider for the rental property. And also you can consider whether it's a residential or commercial, and that calculation would be a bit different, because on the commercial properties the tenant will pay for all of those expenses. So first, as any investment, you have to see what's the rate of return, and are you losing money or are you making money. The other thing that you have to consider is just your risk level, because the interest rate is low now. If suddenly it goes to even 4 or 5%, suddenly your interest payment is going to go up, and you have to see whether when that happens, the property is still profitable or it's good for you, and you can take a risk with your job or business that you're running, that you can pay the mortgage. So that is very important. It has been a couple of changes in the tax rules as well. So before, you used to be able to claim the taxes against your personal income and get the tax return or tax refund back to your account. But now those tax losses are ring-fenced in your rental property, and you cannot use it for your personal income. So you have to consider that, because before they used to calculate that, and if you're not aware of that, you think you're going to receive a refund and claim those, and you cannot do that anymore. So keep that in mind. The other thing is basically bright line test. So you have to keep that property for 5 years before you can sell it. So if you're buying a property and you're planning to sell it in 3 years, you're going to be up for a capital gain tax. So 5 years at the time that you have to keep it. So let's look at that scenario. If you buy it and you can't afford it and you sell it after 3 years, and I hope you make a lot of money, you have to pay tax on that, which is, I guess, is fine, but you need to know. The other thing to consider is, just as far as the ownership of the property, everybody only think about tax. But you have to think about other aspects of it as well. Relationship properties, your risk for your business. So picking up an entity that is going to work for you is not necessarily the one from the tax point of view. It would be the one that serves you right for all aspects of the risk levels you have. So make sure you have a chat with us or another accountant. You can make an appointment using the link below and have a chat with us. There's no obligation. Before you buy the property, you need to do that before you sign an agreement, because when you sign an agreement, you have the name of the owners and everything there. So we have to have a look at that and give you the right advice.